All right, thanks. It's great to be back here. Today I'm going to be talking about overnight edges. It's something that you probably won't hear from any other presenter here. It's not an edge that lots of people look to take advantage of, but it's one that I've taken advantage of for years. I've been trading the overnight since 2005, and I've taught people how to do it since 2012. So let me get into it before I do. Here's a disclaimer. Give you a few seconds to look this over. Basic idea here is that trading is risky, and if you haven't found that out yet, you haven't traded much. A lot of what I'm going to be showing here in the presentation is based on hypothetical back-tested data. That's not the future. It doesn't always act just like the past. Personally, I've found backtesting to be a great way to learn about the market and to teach me about what has worked in the past and to give me an edge going forward. Here's just a quick look at what we're going to be talking about today. I'm going to talk about the history of the overnight market. I'm going to keep that. I'm going to talk not much about my own history, just to keep it going in here. Talk about using futures and ETFs when considering how you want to trade the overnight. I'm going to talk about some research. I'm going to show some research. I'm going to talk about tendencies. We're going to talk about seasonal considerations, price action, other types of tendencies that we see in the overnight market. We're going to talk about the beliefs we have at InvestaQuant with regards to our overnight edges products, with regards to trading the overnight, and I'm going to talk to you about some tools. I'll show you some tools that we use there, and then reasons that you might want to consider trading the overnight. It's not for everybody, but it's something that I've found to be a great time frame for me, and many others that have followed me over the years and that follow us currently at Overnight Edges or at InvestaQuant, right, with our Overnight Edges product. So I'm not going to go too much into this. The highlights here are that I first started noticing overnight edges in 2004, and I launched a site based on my research in 2012 called Overnight Edges, and that became part of InvestaQuant in 2014. So it's been at InvestaQuant for the last 3.5 years, and we've seen some upgrades since and some continued good performance. So I'm thankful for that. This little chart lets you know the time frame that I'm looking at, right? What we're really talking about here on this chart is the dotted lines between the daily bars. This is a daily chart of ES.D, which is in TradeStation. It's the security that represents the S&P 500 futures index on an intraday basis or on a daily basis. So it opens at 9:30 and closes at 4:15. I could use SPY. I could use any derivative of the S&P here. But the basic idea is that we're looking to measure movement from the 4:15 futures close, or if you're trading ETFs, the 4 o'clock NYSE close, and then the open of the New York Stock Exchange the next morning. And that's where that's the time frame we're trading in. Rather than trading where most other people are trading between 9:30 and 4 o'clock, we've got the opposite going on. Let me talk a little bit about day versus night. The market's only open 6.5 hours a day. That means it's closed 17.5 hours a day. And it's only open 5 days a week. So less than 20% of the time, the market is open. And what we find is that most market moving events, that includes earnings, are announced outside of market hours, right? So most things that are going to change the price of securities or of the futures, of the market as a whole, happen outside of market hours. Day traders and institutions are keenly aware of this, and they're willing to pay a premium to avoid what they refer to as overnight risk. I often call it overnight opportunity. Overnight traders like myself will look to absorb some of this perceived risk and will collect premium, right? So we'll act almost as an insurance company. If they're worried about something for the overnight, they'll be paying a premium to get out of the market ahead of tomorrow morning, and I'll be getting in much of the time. But I'll look at historical probabilities, and we'll filter the opportunities and only participate in scenarios that offer strong risk reward. And this does include short scenarios as well. So it's not all long side overnight trading. So that's the basic idea. What we're looking to do is identify setups where tonight we think there's a good chance that the market's going to gap up tomorrow morning, or it's going to drop and gap down tomorrow morning. And we'll look to take advantage of those gaps before they happen. I'm not the only one that sees great opportunity in overnight trading. The chart here shows the growth of the overnight activity since 1998. And there's been a dramatic ramping up of overnight activity in recent years. In fact, the last bar on this chart is from February, and what we see there is that it was the highest dollar volume month ever for overnight activity. Liquidity is generally viewed as a good thing, right? It helps you can get in, you can get out. So the overnight's becoming more popular, and it allows you to get in and out easier. Of course, when I talk about my overnight trading, I consider liquidity to be a luxury. And that's because it's not required to take advantage of the edges that we use for overnight trading at InvestiQuant. Trades typically happen near the close. That's when we initiate trades, and we exit those trades near the open in the next day. And those are the two most liquid times a day. So if you're trading futures or ETFs or some derivative of the S&P or NASDAQ, you're trading some of the most liquid securities in the world at the most liquid times of day. So liquidity is not really an issue for most trades. It can be an issue if you're looking to trade during the night. So if you've got a stop in place during the night, if you're trading futures, for instance. Slippage is minimal at the open and the close. So that's also, and it's because you've got so much liquidity going into the market. And that's an important thing to keep in mind as well. All right, this next chart that I'm going to show, this is a SPY. This is the ETF that tracks the S&P 500, and commissions and slippage are not included. This is just showing what overnight performance would be is if you held SPY from the 4 p.m. closing until the market opens at 9:30 the next day. It goes back to 1993, which is when SPY began trading. So this simply looks at one share overnight, and this better allows us to measure the total points gained and lost over the years. What you can see is that the upslope has been fairly consistent. Well, only brief dips in the 2000 and 2002 bear market and the 2008 bear market, and then there was a dip in 2016 as we had some unusual overnight activity that year as well. Those were the only years where we didn't see net gains. So the entire history from 1993 through a few days ago, SPY gained it was through March, early March. We had a net gain of $245.46 during this period. And this does not include an additional $58 in dividends paid to shareholders. So about $300 in gains occurred in SPY during the overnight. Now, SPY today closed at 265. When it opened in 1993, it was at 40 something. So if we've gained this much in the overnight, that's fairly amazing. That means not that means more than all of the gains since 1993 have occurred at night, not during the day when the market was open. Let's look at the opposite. Let's see how the day has performed. So this is SPY performance during the day. Same thing, holding one share. And what we've had from 1993 till now, 25 years, you're looking at a net loss of $21 during the day. 2018 is currently negative. It would mark the 14th year out of 26 years in which SPY was a net loser during the day. That's fairly amazing. If you look at the chart here, it's interesting to me in that during the bull market of the 90s and the bull market from like 2003 to 2007, there was very little gained during the day. Though it was mostly sideways markets during the day, and gains were made mostly all at night. The most recent bull market since 2009 really has had a bit of a change in character, and where we've seen gains occur during the day as well as during the night. When we think about bear markets, though, the bear markets have happened mostly during the day. You see huge losses in the 2000-2001 bear market, and again in 2008. The reason you see losses occur during the day is that during a bear market, there's real selling going on. And if institutions need to liquidate positions, if they need to get out of the market, they can only do it during the day. You got to do it when the market's open. So real selling will happen during the day. Now, if I go back and show the night, there was mild declines during the night, right? It didn't do great, but it was the day that really got hammered. Seeing these charts is what got me real excited back in the first time I created these charts was in 2004. And so that's what led me to go and further my research in overnight edges. All right, let's talk a little bit about trading futures versus ETFs. The basic differences here are that futures markets are open 24 hours a day or 23 hours a day, right? 5 days a week. And you've also got it reopens on Sunday at 6 p.m. Eastern time. So because of that, you can use stops and targets on futures. Futures are also highly leveraged. You don't need to use all that leverage, but you can. You really need to think about it and talk to your broker and understand the implications of using a lot of leverage, though. ETFs, for most brokers, you see after hours closing around 8 o'clock Eastern time, and then you got a pre-market at 8 o'clock Eastern time. There's no Sunday night session. I think TD Ameritrade now offers 24 hours trading for ETFs. And during that time, you can set targets. You can't set stops during these illiquid after-hour markets. Or when I say illiquid, it's illiquid for the ETFs, or less liquid for the ETFs, because there really aren't that many brokers that allow it, right? So you can use leverage with ETFs. You know, you can use triple ETFs, double ETFs. You can do the long ETFs, the short ETFs, but it's not inherent. A lot of leverage is inherent within futures. So either futures or ETFs can be used to take advantage of overnight edges, and I have historically used both, and to this day I still use both, because I have accounts that are futures accounts and I have accounts that are equity accounts. So I'll use both. All right, let's talk about a few simple overnight tendencies so you have some idea of the kinds of things that we look for and how we can find edges in the overnight. So This chart's similar to the historical SPY chart I showed earlier. Instead, it looks at ES action over the years. And it's simply a profit curve that looks at returns if someone were to buy ES settlement at the close and then exit at the open the next day. So no commissions are included, no stops or targets were used. And the reason we don't include any of that when conducting studies like this is we're simply trying to learn about market behavior. We're trying to see what the tendency is when this setup occurs. It's not a system, but it provides us useful information and ideas to build systems from. So this chart looks at overnight returns if you bought ES each day, which closed up on the day. So in other words, settlement price today was greater than the settlement price yesterday for ES. Now, as you can see, despite the tendency I showed earlier for the market to rise over the years, it's actually fared pretty poorly following up days. All right, so let's look at the opposite now. This is what's happened when ES closes below yesterday's close. Here we're looking to buy the settlement, sell the next day's open, and what we see is there's been a strong upside tendency. So the bottom line with these two tests is the night will often see a reversion of what occurred during the day. That's pretty interesting. But what's just as interesting is that this reversion phenomenon has also been in play versus the previous night, not just the previous day. So to see what I mean, let's check out the next chart. All right. In this case, we're looking at returns of buying any night in which the market had gapped up from the previous night, right? So if ES opens up this morning, then you look to buy it for the next night. So you had one good night, let's buy the next night. And what we see here is, again, a negative tendency when buying after the night had closed up the previous day. Let's also examine what happens after a gap down. This is even steadier than the other one, I think, when we're looking at the close. So if it gapped down today, then there's a pretty good chance it's going to gap up tomorrow. So gap ups are not necessarily followed by gaps down consistently, but there's been a downside edge. Gaps down have pretty consistently been followed by gaps up. That's kind of neat. All right, so let's look at what happens when we combine these concepts, right? Here we're looking at what I refer to as a double up day. All right, that's a day where ES gapped up and closed up versus yesterday's settlement price. All right, and for a long time, that was a real negative tendency. And over the last several years, while we've seen the overnight do very well, this still hasn't done well. So double up days can be dangerous for trading overnight. And I generally avoid going long if we've had a double up day. Most of the time, I will avoid going long after a double up day. All right. What about double down days? All right. A double down day is when we open below yesterday's close and we close below yesterday's close. Doesn't matter what happens in between. It's just we gap down this morning and we close down versus yesterday's close. This is a double down day. And as you can see, this has been really quite consistent. Nights like this, I never take overnight short trades. Don't do it. I avoid short trades on double down days. Okay. Of course, it's not just one day's action that lets us know what's going to happen the next night. So I also look at things like short-term positioning, long-term positioning of the market, seasonality. Here's an example of short-term positioning. So here we're looking at after closing at a 5-day low yesterday, we get a gap up this morning, and then the market closes up at least 1% on the day. So you've got a strong double up day, but it's coming off of a 5-day low. So in this case, there hasn't been a real bearish tendency. Actually, it's made some gains over the years, not consistently, but we haven't seen the bearish double up day tendency, and that's because we're coming off of a low area. You might catch some bears that are stuck there, right? So you're at a low, you gap up, you close higher. They're not getting let off the hook overnight, and that's what we're seeing here. But if we are at a 5-day high yesterday, ES gaps up this morning, closes up 1% on the day. Now you're overdone to the upside, and you got a really good chance of seeing a gap down the next day, and that's what we see in this chart. Okay. All right. Let's talk a little bit about seasonality, and I got a great seasonality study for tonight. We got a Fed day tomorrow, and Fed days have historically provided a nice seasonal edge. All right. So this looks at going back to 2000, anytime there was a Fed day the next day, meaning it's the second day of a Fed meeting, or if it's a one-day meeting, you know, it was just that day, and they are going to have a policy announcement. A lot of times people get worried going into Fed days, but they've had a strong bullish tendency, and then that started the night before, and you can see it in this chart. What's interesting about Fed days, though, and a lot of seasonal edges that we see, is that, and I'm not the only one that knows this. I'm not the only one that knows that Fed days have been bullish over the years. It's been that way since 1982. So sometimes they get front run. And sometimes you get people going in the afternoon before the close. And when that happens, it can kill the overnight edge. Unfortunately, that's what happened today. So if we look at it and say tomorrow's a Fed day and ES closes in the top half of its intraday range, meaning it closed pretty well in a day, possible front run. Now you see the curve is a bunch of chop that's really gone nowhere, and it's not a strong upside edge. What if we close in the lower half of the intraday range? If that had happened today, I'd be here saying, oh, check this out. We got something for tomorrow, because that's what the chart looks like. So these are the kinds of things that we explore at InvestiQuant, and we include in overnight edges. Let me quickly go through a few examples of what you can find on the website as well. The overnight markets offered very consistent edges over the years, and that's something that we've seen over and over and over. And by looking at things like price action, like I showed in the double up and double down days, looking at internals, we look at breadth type indicators and seasonality, like the Fed days, you can enhance your odds. Pattern studies are also useful, such as the 5-day low or 5-day high when you have the move up. Some of the tools that we use at InvestiQuant, we call the index roll-up, the edge finder, trade discussion room, and the blueprints and automated alerts. I will show you those quickly. This is our index roll-up page, and this gets updated every minute leading up to the close for the last 45 minutes of trading, so that you can see what the odds are. The basic idea here is that if something's showing up in green, that means it's got a pretty good up gap percentage and profit factor. I won't get into too many details on this, but that means you got decent odds. So I generally look for an up gap percent of 55% and a profit factor of 1.3. And I often look at ES and NQ since they're the ones I trade the most often. And I look at the roll-up averages at the top as well. So this shows us our 4 major futures and ETFs for the S&P, the Dow, the NASDAQ, and the Russell. This is something I go over every day every day that I'm in the trading room. The Edge Finder has useful studies that'll appear. All right, so These useful studies are similar to the Fed Day one where I mentioned earlier. This is an example of one that might pop up. We have a trading discussion room. I'm generally in there 3 afternoons a week. It changes from week to week, which days, but we discuss the overnight potential, including the odds, any special studies. Blueprints are basically systems that we use. So if certain conditions are met, these systems automatically alert and people can take the trades in those systems. All right, and any other considerations. So an example of other considerations might be the fact that we have employment report coming out on Friday, right? So Thursday, I'm normally pretty cautious if we get an employment report the next morning about taking trades. The blueprints are defined rule sets, and there's 3 different blueprints. They were all released in 2016, and we have automated alerts available for all of them as well. So looking at the website, you can see if any of them are trading as we reach the 4:15 close, and then 2 of them actually have their official triggers at the 4:30 reopen. Okay, so it'll let you know, hey, we got a trade at 4:15, and when it reopens, and we're gonna go long or short. Plenty of reasons to consider overnight trading. The biggest thing for me is that it's non-correlated to anything else I've traded, and it's pretty easy. I look at the odds near 4:15, I determine whether I want to go in or not. I set my trade. If it's a futures account, I'll set my stop and my target. I get out the next morning at 9:30, and the money's available if you're a day trader to day trade. Okay. With day traders, they can compound their returns through overnight trading. And lastly, as we are nearing my time limit here, I'm sorry I rushed through those last couple of slides, but I'm happy to answer any questions you might have. We do have a special offer good through Sunday. So it's annual subscription is normally $24.99. You can get $500 off using the coupon code OE500 promo. Or you can apply it to a monthly subscription, which basically will take $500 off the first month. And since it doesn't cost $500 a month, that means the first month is free. And then it'll renew at $249 a month, starting in month 2. 30-day money-back guarantee on everything we have at InvestQuant. So if you started with the annual and you decided within the month that it's not for you, that you don't like overnight trading, that you can't sleep, whatever it is, you can go ahead and cancel and get your money back. But we did this. I'd love for everyone to at least try the free month. I'm sure you'll learn a good amount trying out the free month, and hopefully you make a bunch of money doing it as well. And you find that you're comfortable in trading the overnight, as I've become over the years. So you can reach me with any questions at rob@investquant.com, and I sincerely hope some of you try it, and let me know if there's anything I can help you with regards to overnight trading.